My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make a little money. My job is not just to entertain you, but to educate and teach. So call me at 1-800-743-CNBC or tweet me, don't be nice, at Jim Cramer. In football, they talk about a concept. It's called any given Sunday, meaning on any given Sunday, a weaker team can beat a stronger one. We call it an upset. And if you're a gambler, the payoff on an upset can be gigantic. But as always, betting on an underdog is risky. They can look terrific in the first half before crumbling into the close. And that's how I feel about today's action. When the market started soft, then roared with things looking real good around midday before the whole thing collapsed at the close. Dow ultimately inching up just 36 points, but the S&P sinking 0.65%, and the Nasdaq tumbling 1.1%. Sell, 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 sell. Sure, the Dow did okay, but investors care a lot more about the S&P and the Nasdaq. That's where the real wagering is, not the antiquated Dow. Remember, right now, bulls are looking for signs that the Fed's winning its war against inflation. Something that will give them an excuse to go a little easier in the economy. On any given day, we could get some bullish data, a couple of good points here and there. And if they're big enough, it gives us a glimpse into what the market will look like when the Fed is done bringing in the pain.
The House of Pain.
Today we got a temporary upset. Let's call it a first half upset. Why? Well, we came in, oil was down. Oh, well, you like that if you're a bull. It stayed down all day, even better. Crude's been a mainstay barometer. Anytime it rallies, it drives policymakers just bonkers. Given that OPEC Plus recently cut production, today's decline in crude says, hey, maybe we shouldn't panic. The price is going right back to 100. It was a very good sign. Now, I acknowledge that these day-to-day moves can mean nothing. But you have to remember that the bears, not the bulls, are in charge right now. So when the bears see oil plunging, they get nervous. Short sellers have made so much money in this market betting against stocks that when they see anything going against them, they're quick to want to take profits. And shorts ring the register by buying back stocks. Buy. Just like the longs make their money when they sell stocks. The bears would be less nervous if it weren't for the producer price index number that's coming out tomorrow morning. Almost all the components like trade services, warehousing, construction, transportation services have either stayed flat or fallen since the last report. How do I know this? We have them all on the show. That's one of the reasons why we have these guys on the show, to get the pastiche, if not the mosaic, of the economy. We know that other than last week's non-farm payroll report, the Fed really only cares about the consumer price index at this moment, and that comes Thursday. Now, those numbers are potential bombs. Still, the PPI, as we call it, is more like a landmine, and the bears don't want to step on it. Now, we got some terrific, in quotes, news about housing today, too. The Bank of America's Institute reported that its, and I quote, growth rate in wire payments to escrow and title companies has been slowing and turned negative in 2022, end quote. In other words, fewer home builders. That dovetails with what we heard from the New York Fed, which talked about household spending expectations falling sharply, with their largest one-month decline since they started collecting this data in 2013. Home price growth is now declining, too, the lowest since June of 2020. Now, I'm going to give you a little primer on the housing business. Stop me if you're in real estate and you sell it and buy it, but otherwise keep listening. What does all this translate to? It means that home sellers must be ready to start banging down bids. Sell. Remember, the Fed's on a crusade against housing inflation, and they can't win as long as there's a widespread belief that if you buy a house, it's going to go up and down. However, if you think your house may be losing value and it's for sale, you're going to do something that people haven't been doing for years in this country. You're going to lower the price of your home to make it move. Now, the Fed's desperate to break this cycle of rising housing prices, as homes have gone up an average of 40% in 2 years. We know how the housing cycle works, though. When there are too many homes, the Fed cuts rates, and buyers step in, prices start going up and a lot of volume trades. The home builders, of course, when they see that, they start adding capacity. Then we get to a point where mortgage rates go up, and while new homes keep being bought, the sellers who are used to ever rising prices now wait to see if there might be an even another leg higher. Greed! At that very moment, an amazing thing happens. Just like with stocks, the dreaded equilibrium is reached and greed turns into fear. Homeowners start getting nervous that they're being too pricey, that they're being too greedy, that they'll miss the top. It's a big game of chicken where some try to stay higher, but others just give up and they start taking their offers. And then the cycle turns. It always does. And prices start coming down and then start outright plummeting in the more inflated areas. This is exactly what happens. If the new homes from the home builders aren't stopped in time, there will be a severe industry correction. And that takes a lot of the inflationary stress out of the system. You must know that the Fed wants a severe industry correction. They want your home to be worth less money. It's okay. We know that home products companies like Leggett & Platt had a negative pre-announcement last night, and that company, which has a little to do with autos, but it's got a monster home business in betting. Well, that's good news. That plays to the Fed's playbook. Again, when we see that we get encouraged, not discouraged, it means the Fed's winning, and it's bringing down the house crusade. Now, here's the issue with all of this. Every game's got two halves. Everything I just gave you is from the first half, the morning, when it looked like the Bulls were winning. But then as the afternoon went on, traders, particularly short sellers, start thinking that as good as these data points are to make the Fed ease up, well, wait a second. Maybe they're absolutely terrible when it comes to the earnings of companies that are involved. Is it really good for Home Depot or Lowe's or Macy's if people are spending less money in their homes? Do you want to own a stock in a paint company or artificial decking maker? How about Whirlpool? They lose all that original equipment money. How can Wayfair do well if Leggett & Platt did poorly? It can't. It's almost impossible to imagine any of the plastic or chemical building plays. How about the paint companies doing well if the economy's slowing enough to make the Fed scale back its rate hikes? Oh, and the skittish tech owners can't take pain, and they bolt as always near to the end of the day. Whoever owns these tech stocks, I got to tell you, there's Xanax, there's Lamictal, there's Klonopin, there's Seroquel. Hey, I took one of those on a Friday. I woke up on Sunday. Today is a day when the Fed always wins. Always. Okay? Once they get aggressive about tightening, all sorts of companies start doing badly. Then let's throw in some bombs. We know this administration generally favors labor over capital. Have you noticed? When we hear the gig economy workers like those who work for Lyft or Uber may be considered contract employees who are entitled to much bigger benefits, we know that's the Biden administration trying to give workers a bigger piece of the pie. Hey, good for them! Obviously bad for the stocks of Uber and Lyft. Surprises like this are all negative for the stock market. We can't expect the White House to do anything pro-stock, except maybe as a side effect of something else they actually care about. By the way, the chaos in Britain is just as bad, where the finances of the entire country seem to be up in the air, both because of some impenetrable pension rules and a hapless government. That led to a big reversal in our bonds. Oh, man, nothing's good at the end of the day. In business, I always say there's no give without a get. Right now, the give is that you get your portfolio all going down. The Fed's bringing the pain unless we all make money. The get is that you'll eventually be rewarded with lower inflation followed by lower rates. We're very much in the first phase, though, the give phase, where we're giving up earnings gains and upside surprises. This is the phase where we get excited when business is weaker because it means the Fed might not have to hurt us so badly. The question is, how long do we have to wait between the give and the get? Will it take ages for the lower prices to sink in? Let me give you the bottom line here. On any given Sunday or Monday night, the Raiders can be beating the Chiefs in the first half. And then the Chiefs can come back roaring big, make a huge disappointment. Today was a day when the Raiders were in charge in the first half. But holy cow, the figurative Chiefs, yes, the absolute overdogs, the favorites, won. Despite spotting the Raiders in an awesome first half lead. Can we please go to Charlene in Pennsylvania, please? Charlene.
Hi, here I am.
Hey, Charlene, how you doing?
I'm doing very well. Go Phillies.
Go Birds.
Yeah, go Birds also.
A couple of Phillies talk, you know. All right, what's up?
Just wanted to know what my future was with DocuSign. Very disappointing.
Pain! We don't want to be in DocuSign. They don't know what they're doing. They don't even, I don't even know if they can figure out, like, who should run the company. They got some new CEO. This is a pandemic play and the pandemic be ended. Except for it's kind of back, but no one's using DocuSign more than they used to. I'll give you a threesome: Peloton, DocuSign, and the Atlanta Braves. I'm sorry, I meant Zoom. Okay, Mark in Iowa. Mark.
Hi, Jim. I hope you're doing as well as your Eagles are.
Well, I'm as well. There's my Eagles and my Phillies. It's kind of a great time to be a Philadelphia fan, as Coach Nick said the other day in a great press conference. How can I help?
Well, I'd like to know what you think about a stock of a company that's back down to its pre-pandemic price level. I do know that from listening to you that the Feds will raise the interest rate to the point that the WFH factor is lower. So what indicators should I look for, or price point should I look for, that would tell me that the dividend would be protective during these times for PG, Procter & Gamble?
All right, Procter & Gamble's got one of the best balance sheets in the industry. They're an amazing company. It's obviously in free fall. My Chapel Trust has been buying here. Why? Because we think raw costs are going to come down and be able to keep up the prices of premium. I got a piece later in the show that demonstrates exactly why this could happen. But right now, it's hated as if they're going to pre-announce any day now. I'm not sure they're going to, but I would tell you that it's not expensive versus its previous years. In business, I always say there's no give without a get. Right now, the give is you're giving up gains in your portfolio, and the Fed's bringing the pain until we all make less money. The get is you'll eventually be rewarded with lower inflation, followed by lower rates, and then higher stock prices. On Mad Money tonight, yesterday we covered the best and worst of the Dow, and tonight we're taking a closer look at the S&P to get a sense of what's working and not working there. And boy, there's some real bad. And in the midst of a continued volatility, I'm still a fan of individual stock picking. Okay, so let's do this. Let's go off the charts on a handful of names that could actually work in this environment. And CNBC's own Julia Boorstin is out with her new book, When Women Lead. And I'm learning more about what she learned and how it could apply to your investing strategy. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.